It's really true. ETFs are the best way to grow your wealth through investing. But what is the best way to get started with ETFs here in Europe? Over my 17 years of professional experience, I've invested hundreds of millions of euros in ETFs and their cousins index funds. In this video, I've put together the ultimate guide to growing your wealth with ETFs for investors in Europe. But first, why are ETFs the best way for most Europeans to invest? So most people use ETFs to invest in stocks, and you probably realize that stock investing is powerful, right? Maybe you've heard about Robert Morin, the librarian who saved and invested in stocks and built up wealth of $4 million. Or Anne Scheiber, the retired civil servant who started stock investing with $5,000 and ended up with over $22 million. But even if you didn't get lucky with amazing profits, even if you just invested 10,000 euros in global stocks 20 years ago and simply got the market average profit, then today you would have almost 50,000. Alright, so stocks are great, but why are ETFs the best way for Europeans to invest in the stock market? Well, if you want to make money from stocks, there are two ways you could do it. The first method is stock picking. Now, stock picking is a lot like mushroom hunting, which is a favorite activity for many of us Europeans. That's me in the picture, by the way. To get the best mushrooms, you need to know the right time of year and which parts of the forest are best. Every hunt takes many hours, and you're not guaranteed to get results. And similarly, when stock picking, you have to choose from thousands of different stocks in the market. You need to read a lot of financial statements. You need to model them in Excel. You have to follow the news and figure out the best moments to buy and sell. It takes a lot of time and effort, and you're definitely not guaranteed to get a good result. Actually, it's quite a bit worse than that. Over the past century, more than half of the stocks in the US stock market actually lost money for investors. Now, the market as a whole, it was really reliably profitable, but the average stock lost money. How is this possible? It's because a few exceptional stocks earned really big profits and pulled up the average for the whole market. According to Arizona State University professor Henrik Bessenbinder, over the past 90 years, there were around 26,000 different stocks in the US stock market, and just 83 of those stocks were responsible for half of all the wealth created for investors. That's 83 stocks out of 26,000. It's a bit like you had this huge forest like the Schwarzwald in Germany, and there's just this one little corner with just a few trees where you can find all the best mushrooms, and the rest of this ginormous forest only has wormy or poisonous ones. Once you understand this, once you understand that the typical stock is not really very profitable, then you have a big advantage over most beginning investors. Because you now realize that picking individual stocks doesn't just take a lot of time. It's also likely to get you poor results. So what do you do instead? Well, this brings us to the second method for investing in stocks. Instead of going mushroom hunting in the forest, you can drive to the store and buy a selection of lovely mushrooms picked by professionals. Of course, I'm talking about buying an investment fund. A good investment fund will invest your money in a portfolio of hundreds of different stocks. A diversified portfolio like this will capture at least some of the best stocks in the market. The data is really clear. This approach really works. The average investment fund is strongly profitable over the long term. But there is a major problem with investment funds here in Europe, and understanding this problem will unlock the power of ETF investing for you. To illustrate it, let me tell you about a time I got super angry on national radio. So I was on this radio show with a major investment company CEO. And the point of the show was to encourage people to invest their money. And this CEO said, "Oh, look, face it. Investing is complicated. There's a lot of jargon. There are a lot of risks. I mean, you should really leave it to the professionals." And that just pissed me off because this guy was scaring people in order to get them to buy investment funds from his company. And what he didn't mention was that these investment funds, like many in Europe, charge between 2 to 4% per year in fees. So this guy, he would sell these funds to regular people saving for retirement, to parents investing for their children's future. And of course, he wouldn't explain that the extremely high fees that he charged would in fact be destroying that future. Let's look at some numbers because this is an absolutely crucial concept to understand if you want to grow your money with investing. So here's my investing calculator. So let's assume you are 35 years old. So you've got 30 years until retirement for investing. And let's say you have 5,000 euros to invest on day one, and then every month you invest 200 euros. And Well, the long-term average profit in the stock market has been 9% per year, so let's assume that that is your profit level as well. So here's the outcome you would get. Over 30 years, you would invest 77,000 euros, your profit would be 331,000 euros, and your final balance would be 408,000 euros. In other words, for every euro that you put in, you would end up with 5 euros, and that's pretty amazing, right? And by the way, when you look at this picture, can you see the cost of doing nothing? So in this example, it's these 331,000 euros. Most Europeans just leave their savings sitting in the bank account, and essentially they're giving up hundreds of thousands of euros over their lifetime, and most people don't even realize this. Okay, so investing is amazing, but now let's say that we are using a typical investment fund here in Europe. So that means we need to take away around 2% per year in fees. So let me put in 2%, and we see that our final balance drops from 408,000 euros to 273,000 euros. All right. So the actual impact of this seemingly small fee, just 2% per year, is to reduce your final wealth by 136,000 euros or 33%. Do you see how this is a problem? Now, you might say, okay, the fee is on the high side, but my fund manager is the best. They will get me a better result than 9% per year. Well, this is a nice thought, but unfortunately, it doesn't work. There is an enormous amount of evidence that proves beyond any reasonable doubt that fund managers don't have enough skill to compensate for the high fees that they charge. Sometimes fund managers do get lucky and earn fantastic results, but those are just lucky exceptions. Before fees, the average investment fund will earn you approximately the market average profit, maybe a little more. But your actual result, the result in your investment account, will be the market average minus a big fat fee. And if the fund underperforms the market average or even loses money, you still pay the fee. Jack Bogle, the innovator behind the first index fund, put it like this: in investing, you get what you don't pay for. The more you pay in fees, the worse your expected result. So this is where ETFs come in. An ETF is an exchange-traded fund. It's an investment fund that you can buy on a stock exchange like any stock. But it's a very special kind of investment fund. Most ETFs are so-called passive funds. Passive funds don't search the market for winning stocks. They simply buy a little bit of every stock in the market. For example, an S&P 500 ETF will buy every one of the 500 big American stocks in the S&P 500 index. Or an MSCI World ETF will buy every one of the 1,350 stocks in this index. And with this approach, passive funds like ETFs are pretty much guaranteed to earn you the market average result. And because these funds are really simple, they charge extremely low fees. So you, as the investor, you get the market average result minus a very low fee. Okay, so I hope you see how this works. If the typical traditional investment fund gets you the market average minus a big fat fee, and ETFs get you the market average minus a small fee, do you see why ETFs tend to get better results than most investment funds out there? I mean, at this point, the evidence is overwhelming. If you look at research like the Morningstar Active Passive Barometer, over the past 20 years, ETFs investing in American stocks have beaten 90% of all other investment funds. This has been by far the most reliably profitable way to invest your money. This is why Warren Buffett said that with these funds, a know-nothing investor can actually outperform most investment professionals. And the way I put it is this: with ETFs, you get maximum reward for minimum effort. This is a total no-brainer for busy Europeans who want to invest but don't want to become investment professionals. All you need to do is buy some ETFs and just keep investing every month. Of course, in real life, it's not quite as easy as it sounds. ETFs deliver their fantastic results if you trust them and stay invested even as the market goes up and down. In the short term, you will experience many times when your portfolio goes down, okay? There can even be moments like in spring 2020 when the COVID crash made ETFs lose as much as 34% of their value, or the Trump tariff dip we experienced recently in April 2025. Markets experience sharp drops quite often, and if you panic and sell your ETFs when that happens, you can and will lose money. ETFs are passive investments, and that means you need to stay invested passively long term. But if you manage to do that, there's some good news. Okay, so if you just buy an ETF every month, if you don't try to be clever, don't try to pick winning stocks or time the market or choose the best moments to buy and sell, if you simply keep investing in ETFs month after month for years, then in the short term, you will experience ups and downs, but over the long term, you will almost certainly get great results. Which raises a natural question. What if you can't afford to wait long term? Or what if you want less risk in your portfolio? Can you still use ETFs in that case? Well, I will answer that in a moment, because now it's time to share my 7-step system. Here's how I pick the best ETFs for making my money grow. To understand step number 1, you have to understand a common mistake that investors make. A lot of people think that an ETF is a type of asset. You've got stocks, bonds, gold, crypto, and ETFs. But actually, ETFs are more like a wrapper. When you go to your favorite Mexican restaurant, you can get tacos with chicken or pork or vegetables. And in the same way, you can get stock ETFs, bond ETFs, commodity ETFs, real estate ETFs, and even crypto ETFs. Whatever type of investment you want to make, ETFs allow you to invest passively in a diversified portfolio with really low costs. So your first step is actually to choose your asset class or investment type. Let me give you a brief rundown of the most popular choices. And to do this, let's open up justetf.com. Okay, so this is the best website in Europe for finding ETFs. And here on the left-hand side, we have different types of asset classes, different types of investments. The first choice up here is equity. So that's stock investing. The foundation of most people's portfolios is going to be stock ETFs. Investors usually use stocks as the main profit driver in the portfolio. That said, stocks have a significant downside. Especially in the short term, they can be quite risky. The value can fall quite sharply. So if you want less risk in your portfolio, then you might look at our second asset class, which is bonds and bond ETFs. For example, you can find them on Just ETF right here. A bond is basically a loan to a company or government. Bonds still have risk, but it's significantly lower than for stocks in the short term, meaning the price goes up and down less. So a lot of people like to use bond ETFs to reduce the price swings in your portfolio. Just keep in mind that bonds are also less profitable than stocks typically. So for really long-term investors, putting too much in bonds can significantly degrade your portfolio performance. Next up, we have money market ETFs. You can find them over here. These are actually also a type of bond ETF. Money market funds invest in very high quality, very short-term bonds. This makes them into a low-risk, low-profit investment. It's kind of similar to a high-yield savings account. So if you have a lot of spare cash sitting around and you want to park it somewhere safe where it's going to earn a few percent per year, money market ETFs can be a great choice. Then we have an asset class which has been really profitable over the centuries. In fact, it's been so profitable that it competes with stock investing. And of course, I'm talking about real estate. For most of us Europeans, it's easy to understand real estate investing. You buy an apartment, you rent it out, and that can obviously be profitable. But if you know anybody who owns real estate, you know it can be quite a pain to deal with tenants and repairs and all the work associated with owning a property. Fortunately, today we can make real estate investing much easier by buying real estate ETFs. Real estate ETFs invest in companies which buy properties and rent them out, or sometimes they might develop properties and sell them. When you buy a real estate ETF, it's an easy way to get a diversified exposure to the real estate market completely passively. Now, you do have some additional complications. You have some extra business and stock market specific risks that you wouldn't have if you invested directly, but it's the easiest way to get exposure to real estate. And you can find real estate ETFs by going to this section on justetf.com. Next up, we have commodity exchange-traded products. So you can use these to invest in gold or silver or oil or other commodities. In Europe, these are usually not ETFs, but similar products called exchange-traded notes, ETNs, or exchange-traded commodities, ETCs. Now, commodities are usually considered speculative, risky investments, so I won't spend a lot of time on this, but you can find these commodity products either here in the commodities section or in the precious metals section if that's what you're looking for. And then, on a similar note, you can also use ETNs or ETCs to invest in crypto. So instead of having to buy your own Bitcoin or Ether or other crypto coins, which comes with certain risks of fraud and scams, you can buy an exchange-traded product and be quite confident that a big financial company will buy and hold the crypto for you. Obviously, crypto is also very speculative and quite risky, but if you're into it, exchange-traded products can make investing easy. And you can find these products here in this section, cryptocurrencies. Okay, so that's your first step. Choose the asset class in which you would like to invest. That said, for most investors, you'll probably want to start with stock ETFs, because when we invest in the stock market, we invest in the global economy. Almost all of my personal ETF portfolio is in stock ETFs. So as we move on to step number 2, I'm going to assume that we're investing in the stock market. Here in Europe, many ETF investors make a critical mistake. They assume that buying ETFs means buying the S&P 500. Okay, so the S&P 500 is an index of 500 of the biggest American companies. You've got Apple, Microsoft, Tesla, Nvidia, and the rest. Historically, investing in this index has been incredibly profitable. But although it may come as a shock to some viewers, America is not the whole world. Yes, of course, you can invest in American stocks. With an S&P 500 ETF or an MSCI USA ETF, you're investing in the biggest stock market in the world, which has had the best historical performance. But on the downside, all your eggs are in one basket. And especially with the recent political instability in America, many investors see this as risky. So if you'd like to diversify more broadly, you could use ETFs which invest in developed world stocks. So these would be funds that track the MSCI World Index or the FTSE Developed Index. Or you could buy emerging markets ETFs. These invest in hungry, fast-growing economies like India and Brazil and others. When things go well, emerging market stocks can be very profitable, although the last decade has been disappointing. Then there are so-called all-world ETFs, which combine developed and emerging markets. So these funds track indexes like the MSCI ACWI and the FTSE All-World Index. And finally, some investors today want to invest in developed markets but stay away from American stocks at all. And that's also possible. You can find ex-US ETFs as well. When you go on justetf.com, you can go here to region and choose different regions, or you can choose specific countries over here, or you can just use the search bar. And for example, if you're looking for an ex-USA fund, I would just put that in, and you will see what choices are available. So step number 2 is to choose your target stock market. Let's move on to step number 3, which solves one of the biggest problems for many new European investors. If you watch American investment YouTubers or read American books, they will say that investing is really simple. All you need to do is buy a popular ETF like SPY or VOO or QQQ. And that's it. But when you go to your brokerage here in Europe and try to buy these funds, you get denied. Because of EU regulations, we can't buy American ETFs in the European Union. And that's true in the UK as well. Now, if you live in other European countries such as Switzerland or Norway or Georgia, this restriction doesn't apply to you. But for the rest of us, we need to buy ETFs based in Europe. Don't worry, this is not really a problem. You can still invest in American indexes like the S&P 500 or the NASDAQ 100 if that's what you want. You simply need to use ETFs legally established or domiciled in Europe. And fortunately, all the ETFs listed on justetf.com qualify. If you scroll down here on the left-hand side to fund domicile, you will see that most funds are domiciled in Ireland or Luxembourg, although other countries are represented as well. So step number 3 is to pick the right fund domicile for your ETFs. And that takes us to step number 4. Let's say you want to invest in the S&P 500. Physically replicated or fully replicated ETFs actually buy the 500 stocks in the S&P 500. So-called synthetically replicated ETFs, also called swap-based ETFs, use a bunch of financial wizardry to get you the same result. Most people consider physically replicated ETFs a bit safer, but sometimes synthetic ETFs get you slightly higher profits. And you can make the choice over here on justetf.com under the heading Replication Method. So step number 4 is to choose between physically and synthetically replicated ETFs. Physical versus synthetic is not the only difference between ETF types. Perhaps the most important choice you can make is step number 5, accumulating versus distributing ETFs. When an ETF invests in stocks, it sometimes receives dividends. For example, if an ETF invests in Microsoft, Coca-Cola, or Johnson & Johnson, these companies will earn a profit and pay out a dividend to these funds. So the question is, what happens next? A distributing ETF pays this dividend out to you. The ETF sums up all the dividends received over the past 3 or 6 months and pays them out to fund investors. So that means you receive cash in your account and you can spend it or use it to buy more investments. By contrast, an accumulating ETF does not pay out dividends. Instead, it reinvests the money. In other words, the fund will use the dividends to buy more stocks. So that means that with an accumulating ETF, you don't receive cash in your account. Instead, the value of your ETF goes up more as compared to a distributing fund. So which ETF type is better? Well, this actually gets a little complicated, but basically the answer comes down to your local tax rules. In most European countries, accumulating ETFs get you better results because they don't pay you dividends, so you don't have to pay dividend taxes. Instead, you pay tax only in the future when you sell the fund, and typically that's better. But in some countries, such as Austria or Switzerland, you need to pay tax on accumulating ETFs every year, and in those countries, distributing funds are equally or even more attractive. On justetf.com, finding accumulating and distributing funds is easy. Just go to use of profit over here and select whatever you prefer. There are some other technical ETF features that you can take into account. For example, investment style, company size, fund age, fund size, currency hedging. To keep this video manageable for beginners, I will leave that for another time. So let's move on to step number 6, which has to do with holding on to as much of your money as possible. You see, with ETFs, your expected profit is the market average minus the ETF fee. So all else being equal, the lower the ETF fee, the better your expected result. And that's why step number 6 is to sort your chosen ETFs by fees and focus on the least expensive ones. For example, let's say that on justetf.com, I've chosen global accumulating physically replicated ETFs, which are domiciled in Ireland. Okay, so that leaves me with 319 ETFs to choose from. To find the cheapest ones, I would go to this column, TER, total expense ratio, and I would click on it. And this sorts the funds by fees. Okay, and here at the top, I have some of the cheapest funds. For example, the Amundi Prime Global UCITS ETF, which charges just 0.05% per year. And you can compare that to typical investment funds sold by your bank, which might charge 1 or 2 or even 3% per year. Then you have the Amundi Prime All Country World UCITS ETF, which charges 0.07%, and so on down the line. Now, I would not blindly just choose the absolute cheapest fund that I can find. I would make sure that the fund is from a reputable company, that it has decent size, and that the investment strategy makes sense to me. Plus, I would check that it's a good fit for my local tax rules. But when I sort by fees, it makes the choice much easier. And this leaves us with only step number 7, which is to study your top 5 or top 10 chosen ETFs in detail to make a final choice. So for example, if I'm really interested in this Amundi fund, I would open it up here on JustETF, and I would look at the description and download the fact sheet and the key information document and study all the other information available here as well. I would probably also go to the fund website and see what more I can find out there. I want to make sure that I understand where the fund invests, what the costs are, and other basics. And then, once all of that is done, I would choose 1 or 2 ETFs for my portfolio. Now, there are some other important factors you should consider, including how to adjust your ETF selection for your local tax rules and which brokerage or investment app you should use for investing. But before I talk about all of that, let's just do a quick demonstration of how to actually buy an ETF. Let me be really clear that this is not an investment recommendation. This ETF will be appropriate for some people and not for others. It depends on your goals, your age, your risk tolerance, what country you live in. I mean, in some European countries, because of tax rules, it could really be a suboptimal choice. But for now, let me just go ahead and show you how simple it is to buy an ETF like this. So what I need to do is open up my brokerage account. Now, as an investment trainer, I've got like 15 different brokerage accounts. This is Trading 212. It's not my primary account, but it's an account I use all the time for doing demonstrations because the user interface is really simple. It's easy for beginners to use. So a brokerage like this is basically a supermarket for investments, with the added difference that a brokerage also holds on to your investments after you buy them. So this makes it extra important to pick a good one. Every brokerage has a different user experience. With Trading 212, when I log in, I see information about the most traded stocks and the top winners and the top losers. As a long-term investor, I really don't care about all of that. I just want to search for the fund that I need, okay? And the way I usually do it is I go to the fund, I copy the ISIN, so this is a unique identifier, the International Securities Identification Number. So I copy that, I go to the brokerage, and I paste it in the search box, okay? And here we have the Amundi Prime Global ETF. I can see the current price, and I can see that this brokerage lets me buy it on the German Stock Exchange. So that looks good to me. I open up this view. I can find out more information about the fund if I need it. But for now, let me just do a quick demonstration. So I hit buy. Now, normally when I train investors, I recommend using what is called a limit order, because with a limit order, you can make sure you're getting the best possible price. But for simplicity right now, I'm just going to use what's called a market order. So I will simply tell the brokerage, buy me 1 share of this ETF at the latest available price. So I hit review order. I look everything over, it looks good. And I click send buy order. And it says order placed. And immediately I see that I bought 1 share at 28.26. So stop for a moment to consider what just happened. With just a few clicks, in just a few minutes, I was able to invest my money in hundreds of different companies all around the globe. Okay, 100 years ago, this was impossible for the richest investor in the world. Now, anybody can do it. If you can click through Facebook or Instagram or TikTok, then you can invest in ETFs. And this is why ETFs have really revolutionized investing. It is so much easier than ever before. It literally takes you a few hours per year because you just need a calendar reminder to open up your brokerage account every month. You put in some money, you click a few buttons, you buy an ETF, and that's it. That's all you need to do. In fact, the only real challenge for most people is getting started, because once your portfolio is up and running, I mean, life is great. You hardly need to pay any attention at all. In fact, research suggests that the smartest approach to ETF investing is buy it and forget it. Okay, so every month you log in, you put in a bit of money, and the rest of your time you ignore the market. You don't think about it at all. Okay, and this is what allows you to get those good long-term passive investing results. The main challenge with ETF investing here in Europe is that it feels overwhelming in the beginning. And that's normal. There are 100 questions. Which brokerage or investment app should you trust with your money? What investment strategy is right given your age, your goals, your tax situation? When is the right moment to start investing? Should you invest all your savings at once or gradually over time? And how do you handle taxes? Many new investors get overwhelmed and either don't invest at all or jump in and make expensive mistakes. On this YouTube channel, I help European investors figure all this out one video at a time. But if you'd like a faster, step-by-step solution which goes A to Z through everything that you need to know and includes one-on-one support from me personally, you might be interested in my training program for European investors, the Index Masterclass. Today, our program has thousands of members in 34 European countries, and I think it's the easiest way to start ETF investing if you live in Europe. So to find out more, just follow the link in the description.